Hey everyone, welcome back to where we dive into the world of cryptocurrencies, blockchain, and the latest trends in the digital finance space. Today, we're going to discuss a critical event in the Bitcoin world, the Bitcoin halving. Whether you're a seasoned crypto investor or just starting out, understanding the Bitcoin halving is crucial to grasping how the Bitcoin ecosystem works and what it means for the future of crypto. So, stick around, and by the end of this video, you'll know all about the Bitcoin halving, its impact on the market, and how it might affect your investments. Let's get started. To kick things off, let's talk about what the Bitcoin halving event is. Bitcoin, as you might know, is a decentralized digital currency that operates on a blockchain. New Bitcoins are created through a process called mining, where powerful computers solve complex mathematical problems to validate transactions on the network. Miners are rewarded with newly minted Bitcoins for their efforts. However, Bitcoin's creator, Satoshi Nakamoto, designed the system to be deflationary. This means that over time, the rate at which new Bitcoins are introduced to the market decreases. This is where the concept of halving comes into play. Bitcoin halving is an event that occurs approximately every 4 years, or more precisely, after every 210,000 blocks are mined. When a halving happens, the reward that miners receive for adding a new block to the blockchain is cut in half. Initially, miners received 50 Bitcoins per block when Bitcoin was launched in 2009. This amount was halved to 25 Bitcoins in 2012, then 12.5 Bitcoins in 2016, and down to 6.25 Bitcoins in 2020. The most recent halving occurred recently in 2024, reducing the reward to 3.125 Bitcoins per block. This process will continue until the maximum supply of 21 million Bitcoins is reached, which is estimated to happen around the year 2140. Now, you might be wondering, why was this halving mechanism implemented in the first place? The primary reason is to control the supply of Bitcoin and create a deflationary environment, unlike fiat currencies, which can be printed in unlimited quantities by central banks. Bitcoin has a hard cap of 21 million coins. By reducing the issuance of new coins over time, the halving mechanism helps ensure that Bitcoin remains scarce, which in theory should increase its value as demand grows. This scarcity is often compared to precious metals like gold, which also have a finite supply. Just like how mining gold becomes more difficult and expensive over time, mining Bitcoin also becomes less rewarding and more competitive with each halving event. This built-in scarcity is one of the key factors that many investors believe will drive the long-term value of Bitcoin. One of the most discussed topics around Bitcoin halving is its impact on the price of Bitcoin. Historically, each halving event has been followed by a significant increase in Bitcoin's price. But why does this happen? The main reason is the supply and demand dynamics. When the block reward is halved, the rate at which new Bitcoins enter circulation slows down. If demand remains the same or increases, the reduced supply can lead to higher prices. This is basic economics. Less supply with steady or growing demand typically results in a price increase. Let's take a quick look at the previous halving events. In 2012, after the first halving, Bitcoin's price rose from around $12 to over $1,000 within a year. In 2016, after the second halving, Bitcoin's price increased from about $650 to nearly $20,000 by the end of 2017. The halving in 2020 saw Bitcoin's price surge from around $9,000 to over $60,000 in the following year. However, it's important to note that while past halvings have been followed by price increases, there are no guarantees this will always happen. The market is influenced by a wide range of factors, including investor sentiment, regulatory developments, and macroeconomic trends. So, while the halving is an important event to consider, it's not the only factor that affects Bitcoin's price. Now, let's talk about how the halving event impacts Bitcoin miners. As we mentioned earlier, miners are rewarded with Bitcoin for validating transactions on the network. When a halving occurs, their rewards are cut in half, with the cost of mining electricity, hardware, and other expenses remains the same or even increases. This can lead to a situation where mining becomes less profitable, especially for smaller miners who may not have the economies of scale to compete with larger operations. Some miners might even shut down their operations if the rewards no longer cover their costs. On the flip side, If the price of Bitcoin increases significantly after a halving, it can offset the reduced rewards, making mining profitable again. This is why many miners continue to invest in more efficient equipment and renewable energy sources to reduce costs and stay competitive. Moreover, as mining rewards decrease, miners increasingly rely on transaction fees as a source of income. As the Bitcoin network becomes more congested and transaction fees rise, miners can still earn a substantial income even if block rewards are lower. This dynamic could play a more significant role as we approach the final Bitcoin halvings. The Bitcoin halving event doesn't just impact miners and Bitcoin's price, it also has broader implications for the entire cryptocurrency market. As the price of Bitcoin rises, it often leads to increased interest in investment in other cryptocurrencies as well. This is because Bitcoin is often seen as the gateway to the broader crypto market. When Bitcoin performs well, it tends to lift other altcoins, creating a bullish market sentiment across the board. However, the halving can also lead to increased volatility. In the months leading up to and following a halving event, the market often experiences significant price swings as traders speculate on the potential impact. This can create opportunities for savvy investors, but also poses risks for those who are less experienced. Another important aspect to consider is how the halving impacts the perception of Bitcoin as a store of value. With each halving, Bitcoin's inflation rate decreases, making it more similar to assets like gold. This narrative of Bitcoin as digital gold becomes stronger, attracting institutional investors and long-term holders who see Bitcoin as a hedge against inflation and a way to preserve wealth. So, how can you prepare for the next Bitcoin halving? First, it's crucial to stay informed. Understanding the halving's implications can help you make better investment decisions and manage risk. Keep an eye on market trends and consider how the halving might impact not just Bitcoin, but also other cryptocurrencies in your portfolio. If you're a miner, it's important to evaluate your operations and consider upgrading your equipment or finding more cost-effective energy sources. As the block rewards decrease, efficiency will be key to staying profitable. For investors, consider your strategy. Are you in it for the long haul, or are you looking to capitalize on short-term price movements? Historically, the best returns have been seen by those who hold Bitcoin for the long term, rather than trying to time the market. However, every investor situation is different, so make sure to do your own research and consult with a financial advisor if necessary. In summary, the Bitcoin halving is a significant event that plays a crucial role in the Bitcoin ecosystem. It impacts miners, influences Bitcoin's price, and has broader implications for the entire cryptocurrency market. While it's impossible to predict exactly how the next halving will unfold, understanding the basics and staying informed can help you navigate the changes and make better decisions. If you found this video helpful, please give it a thumbs up, subscribe to the channel, and hit the notification bell so you don't miss any future updates. And if you have any questions or topics you'd like me to cover in upcoming videos, drop a comment below. Thanks for watching, and until next time, stay informed and trade wisely.